Hey everyone, welcome back to the channel. This is going to be a beginner video on how to analyze an options chain. So if you're already well versed in options, feel free to go and check out one of my other videos. If you're new or you've only just done a little bit of research, you probably heard the term options chain tossed around, but do you know how to read and analyze it? Well, in today's video, we're diving deep into the world of options chains, breaking it all down so you can confidently use them in your trading strategy. Before we jump in, make sure to like, comment, and subscribe if you're enjoying this content, and hit that bell so you never miss an update. Alright, let's get started. First things first, what exactly is an options chain? Simply put, an options chain is a list of all available options for a specific stock or asset, showing both the call and put options. It gives you details about strike prices, expiration dates, and premiums, and is essential for making informed options trades. And it is the only way to do options trades on most platforms. In this example, we have an options chain for the stock Apple. You'll notice a few key columns. Don't worry, we'll go over each one. So let's break down the key components of an options chain. The most important for any options chain is going to be the expiration date. Options are contracts. They can have weekly or monthly options available depending on the company. Some companies only have monthly, some do weekly. You can choose whichever you prefer, but the contract will expire when the stock market closes on that Friday. So it's always going to expire on a Friday, and you need to know that in order to determine what kind of options you want to trade and also what kind of time length that you're looking at. Next is going to be the strike price. That's the left column here. So this is the price that you're going to be willing to either buy or sell shares depending on which options you choose. And I'll be going over that in a minute. So with options, there are two options that you can do. Well, technically four. You have calls and puts, which is the two that you can do, but you can buy or sell calls or puts. So you have four options, but only two subsets that you can do. So, and it all depends on what you're looking to do. So if you're wanting to buy shares but get paid for it, you would sell a put. If you have 100 shares and you want to get paid for it and you want to sell them, or possibly sell them, you would sell a call. If you think the stock is going to go up, but you're willing to sell for possibly a higher price, then you would buy a call. If you're thinking the stock is going to go down, but you're willing to buy at a certain price, you would buy a put. Next is the premiums. You see these here on the right side, where the plus sign is, so you can choose that contract. The premium is how much you either pay to get into the contract or how much you get paid to get into the contract. If you are buying a call or a put, you have to pay the seller, and if you are the seller, you get paid in order to take on that contract. Next is implied volatility. This determines basically how much the market expects the stock price to move within the time frame of the expiration date. So the lower the implied volatility, the more stable the market expects it to be. And that also affects the premium price. The more volatile, the higher the premium, but the more risk of it going against you. And next is the open interest and the volume. So the open interest shows how many options contracts are currently open, so not yet exercised or expired, and volume shows how many contracts were traded that day. High volume and high open interest indicate a lot of people are trading this, so there's a lot of liquidity, which is what it's called in the markets, where you can easily buy or sell options on a given day. Now let's look at calls and puts more closely. As I mentioned, when you are betting that the stock is going to go up, that's when you would buy a call option. So for example, with Apple, right now the current stock price is as $245.83. If you believe in the next week it's going to go up, you can buy a call and then If it does go up like you believe, you can sell it before the expiration date for a profit. Just be aware, the closer it gets to the expiration date, the more that the option is going to lose value. If you believe the stock is going to go down, you would buy a put, and the same applies. You hope that the stock goes down, you can sell it back for a profit. Now, if you are thinking that the stock is going to go up or maybe stay in the middle, you can do several advanced ones, but just for a beginner's sake, that's when I would sell a put, just to, more specifically, a cash secured put. I want to make that clear. You do not want to sell any naked calls or naked puts. That's basically when you do not have the money in your account to purchase 100 shares if you sell a put, or if you don't have 100 shares to sell if you sell a call. Never do that. Like, you will at some point lose, and you will lose big, because there's an unlimited amount of money you can lose that way. So stick to cash secured puts, covered calls, which I will go into in another video, and just buying options based on if you think the stock will go up or down. But don't do anything with selling naked options. Now, if you, like I said, if you want to purchase the stock but you want to get paid for it, you would sell a put. Now, if you already have 100 shares and you want to make weekly or monthly income, you can sell calls at a strike price that you like with the amount of money in the premium that you would like to get paid, and that way you get paid. Now I'm going to go over, if you hear the term in the money, out of the money, or at the money, I'll be going over those terms in this section of the video. So for specifically calls, out of the money is anything that's above the share price, like more than one or two strike prices away. So 247.50 would still be considered at the money because it's the closest one to it. So technically the 245 is closer price wise. That would already be basically in the money. So that's why this one's considered at the money, and the 250 and above would be considered out of the money. At the money is exactly what it sounds like. It's the options closest to the current strike price. And then for in the money, that's the opposite for calls. So 242.50 and down, these are all in the money. So if you were to buy a call on these, they're far more expensive, and it would take a lot more for you to make a profit. If you were to sell a call, it's almost guaranteed that you would have to sell your shares at that price. So that's why you get paid more, because it's expected to stay above the price that it's at now, usually. And the same goes for the puts. So here in the puts section, this is actually considered at the money also, like the two closest strike prices. But then it's a little bit different with puts. So up here is considered out of the money. So anything 250 and higher is considered out of the money with puts, and the 242.50 and below is considered in the money. So now I'm going to go a little bit more in depth to show you just the differences in volume and open interest between two different stocks. That way you can see what I was talking about as far as liquidity. So the stock here, Apple, it has a volume of 62,000. So that's how many contracts were traded on the last day that the stock market was open. Open interest is how many contracts are already currently open. That's the ones that haven't been exercised in some way and they haven't expired yet. So that's a lot of open interest, and that's a lot of volume, and that's daily. Now, if we go to another company like AG&C, which is a REIT company, you can see here when you go to the options chain that it has much less. So same expiration date, February 5th, the $11.50 call has zero volume and zero open interest. So chances are you would not be able to trade this option. So next I'm going to be talking about implied volatility. You'll be able to see it on this chart here. And you can see right now that this option has an implied volatility of 44.98% for AG&C. So that's okay. And now let's go back to Apple. And we'll look to see what that implied volatility is. So going to this options chain, wait for it to load. So this options chain right now at this particular part has a implied volatility of 25.15%. So that means the market for this upcoming week doesn't expect that the price of Apple is going to change very much, which does affect the premium. The higher the implied volatility, the higher the premium. So if you are buying a call or a put on a stock that has a high implied volatility, you are going to pay more than you would if it had a lower implied volatility. And if you are selling a call or a put, you're going to get paid more for stocks with a higher implied volatility than a lower. So you see this one here. Let's check out one more company that I know has a very high implied volatility for this upcoming week because of earnings that are coming up for this company. So you can see here the option for at the money for HIMS is $605. So $6.05 premium, but contracts and options are 100 shares. So you multiply the 605 by 100, you get $605. So that's how much you would have to pay to buy this call. Now, if you were going to sell a call, you would instead get paid $585 because the implied volatility on this stock is 269%. So the market, due to earnings, expect this stock's price to fluctuate a lot after the earnings on Monday after the stock market closes. So the higher the implied volatility, the more money that you either pay or get paid. Okay, so you're probably wondering, how do I use this information to make a good trading decision? Here's where your analysis can come in. If you believe that the stock price is going to go up, you can buy a call. For instance, here on Apple, if you believe the stock will go up, you can buy a call for $63. And this chart here from Robinhood shows you that you will make profit if the stock price goes above $253.13. That is the strike price with the price that you paid added to it. So anything above that and you'll start making profit. If it does not go above that, you lose the $63 that you paid. So there is that. Keep that in mind, that you can lose money if it doesn't move the way you want it to. Now, if you are thinking that the stock is going to go down in price, you can do the opposite. You can buy a put. And let's take a look at this one here at $242.50. So you would pay $180. And in this case, the break even, or the strike price plus the premium, means that it would need to go down to at least $240.70, and then you would start making profit. And then if you're interested in doing some more advanced strategies like the wheel, it's still fairly basic, but in those cases, instead of buying, you're selling. So you would sell a put and then you get paid, and then if the stock price goes below the strike price but on expiration, then you have to buy 100 shares, and then you can start doing covered calls to get paid. But also don't forget that the options expiration isn't limited to just a week or a month. Like, you can go really far out. So for instance, buying a call, let's say you believe that the stock price will go up, but you're not sure exactly how long, you can go 40 days out. Just keep in mind that this does increase a premium. So you could pay $231 if you believe in the next 40 days that the stock price is going to go above $262.31. And you can even go further than that. Like Robinhood and most brokerages let you go over a year or two. So for instance, this one here for 390 days, you could buy a call and you pay $1,880, but it doesn't expire until March 20th of 2026. So here your break even would be $288.80. That's what it would have to move above before you start making profit, but it has a whole year pretty much before that expires, so it has more time. And the same thing happens if you want to buy a put. You have more time and you can make more money if the stock price goes the way you think it does over that long time frame. And that's a wrap for today's video on how to read and analyze an options chain. We covered a lot of ground, but don't worry, with practice, and I do recommend paper trading to practice to begin with, this will start to feel like second nature. To recap, focus on the expiration date. Focus on the strike price that you're wanting to buy or sell your options at. Focus on the premiums, how much you have to pay or how much you will get paid. The implied volatility, which will affect how much the premium is. The liquidity of the option, so how much open interest and how much volume is the stock trading for. Use that information to make strategic options trading decisions using your market outlook. If you enjoyed the video, don't forget to hit the like button, subscribe, and leave any questions that you have in the comments below. I will answer every question that's listed. And don't forget to tune in for more trading tips. And happy trading, everyone.